Dividend stocks are stocks that make regular distributions to their shareholders, usually in the form of cash payments. Adding dividend stocks to your portfolio is a great way to earn passive income while building long-term wealth. Hi, I'm Des with The Motley Fool. Let's discuss more on dividend stocks, how they work, and a few examples of stocks with dividends that give you the most bang for your investing buck. A dividend is a distribution of a portion of companies' earnings. Companies usually pay dividends in cash, though sometimes they'll do it in stock. Companies usually choose to start paying dividends when they're stable enough that they consistently have profits left over after reinvesting in their business. When a company pays a dividend, it's directly sharing its profits with investors. There are three ways a company could choose to pay its dividend: regular dividend, special dividend, or variable dividend. A regular dividend is the most common and usually paid quarterly, but can also be paid monthly, biannually, or annually. Companies that pay a regular dividend set a consistent dividend amount, ensuring that it's sustainable in the good and bad years. Special dividends are usually a one-time payment. A company may choose to pay a special dividend after a long stretch of higher than expected profits or a big one-time influx of cash. Keep in mind that when a company announces a special dividend, it's telling you not to expect the payment to become a recurring event. Otherwise, the company would simply raise its regular dividend. Variable dividends are often paid by companies that produce commodities such as oil and gas, timber, and mined materials. These companies sometimes opt to pay a variable dividend in addition to their regular dividend payments. Variable dividends tend to be paid at fairly consistent intervals, but vary in amount depending on the company's earnings in the prior quarter or year. Two common dividend metrics that can help indicate a company's ability to pay dividends are dividend yield and payout ratio. Dividend yield is a stock's annual dividend payment to shareholders expressed as a percentage of the stock's current price. The dividend yield formula is annual dividend divided by the stock price. A dividend payout ratio is a percentage of that company's earnings that it pays out to its investors as dividend income. The dividend payout ratio formula is total annual dividend payments divided by annual earnings. Research has shown that more companies around a 41% payout ratio have outperformed the S&P 500 compared to those at other levels, suggesting that's a sweet spot for rewarding shareholders while keeping enough cash on hand for growing the business. Companies with higher dividend payout ratios may be unable to increase the dividend amount paid. Companies with a lower dividend payout ratio are more likely to increase their payouts over the long term. Not all companies provide dividend income, but there are some dividend stocks to keep on your radar. After growing its dividend yield for 49 years and counting, retailer Target has consistently proven to be profitable with high gross operating margins. Lowe's, the home improvement giant, has raised its dividend for 46 straight years and has raised the payout 471% over the past decade alone. Realty Income owns a wide array of properties that are largely resistant to e-commerce, earning strong cash flows from its tenants on long-term leases. Realty Income pays investors every month, and it's raised its dividend 25 consecutive years. With a portfolio of popular healthcare brands and steady profitable operations in pharmaceuticals and medical devices, Johnson & Johnson has increased its dividend for 58 years in a row. Owning dividend-paying stocks helps you earn passive income and creates a safety net for investors looking to build long-term wealth.